Finance Fundamentals Part 2 Financial Ratios. Introduction. By themselves, financial statements tell you quite a bit. How much profit the company made, where it spent its money, how large its debts are. But how do you interpret all the numbers these statements provide? For example, is the company's profit large or small? Is the level of debt healthy or not? Financial ratios help in analyzing the various financial data easily in a quantitative manner. It also helps in the easy comparison of different parameters of different entities, say businesses or companies. In this presentation, we shall look at some of the important financial ratios. Financial ratios. A financial ratio or accounting ratio is a relative magnitude of two selected numerical values taken from an enterprise's financial statements. Ratios can be expressed as decimal values or equivalent percentage values. Ratios are categorized into different types depending on the parameters interpreted by them. Some important types of ratios are profitability ratios, operating or activity or efficiency ratios, leverage or debt ratios, valuation or market ratios. Let us now look at these different types of ratios in detail. Profitability ratios. These indicate how well a company is able to turn its assets or resources into profits. It expresses sales and profits as a percentage of various other items. The important profitability ratios are return on assets, return on sales, return on equity, gross margin, EBIT margin. It will be helpful to know each of these in brief. Return on assets, ROA. It shows how well a company has invested in its assets. The return on assets is calculated by dividing net income by assets. Return on sales, ROS. It measures how the sales translate into profit. Hence, it is also known as profit margin. ROS equal to net profit divided by sales. For example, if a company earns $10 for every $100 in sales, the ROS is 10 by 100 or 10%. Return on equity, ROE. The return on the financing provided by owners. ROE equal to net income divided by owners' equity. Gross margin. It analyzes gross profit with respect to sales. It helps in checking if a company can meet its expenses. Gross margin equal to gross profit divided by sales. Gross profit is obtained by deducting cost of goods sold from sales revenue. EBIT margin. EBIT margin is also known as operating margin. It analyzes the profitability of a company's operating activities. EBIT margin equal to EBIT, which is the earnings before interest and taxes, divided by net sales. Let us now look at operating ratios. Operating ratios indicate how well a company is able to turn its assets or resources into profits. By linking various income statement and balance sheet figures, these measures provide an assessment of a company's operating efficiency. So they are also known as activity or efficiency ratios. The important operating ratios are asset turnover, current ratio, quick ratio. As in the case of profitability ratios, let us now look at each of these ratios in a brief manner. Asset turnover. It shows how well a company utilizes its assets. Asset turnover can be calculated by dividing sales by assets. Current ratio. This is a prime measure of how solvent a company is. It's so popular with lenders that it's sometimes called the banker's ratio. Generally speaking, the higher the ratio, the better the financial condition a company is in. To calculate the current ratio, divide total current assets by total current liabilities. A company that has $3.2 million in current assets and 1.2 million in current liabilities would have a current ratio of 2.7 to 1. That company will definitely be healthier than one with a current ratio of 2.2 to 1. Quick ratio. It simply measures the ratio of a company's assets that can be quickly liquidated and used to pay debts. Thus, it ignores inventory, which can be hard to liquidate. This ratio is sometimes called the asset test ratio because it measures a company's ability to deal instantly with its liabilities. To calculate quick ratio, divide cash account receivables and market securities by current liabilities. Leverage ratios. Leverage has to do with a company's debt structure. It helps to determine a company's quality of debt and its ability to pay the interest on its debts. Hence, they are also known as debt ratios. The greater the component of long-term debt in the overall debt structure, the greater the financial leverage. The important leverage ratios are debt to equity, interest coverage. Debt to equity. It is a measure of the company's ability to utilize its borrowings to increase the returns on the owner's equity. Debt to equity equal to total liabilities divided by shareholders' equity. Here, the total liabilities will comprise long-term debts plus short-term debt plus current maturities. Interest coverage. It is a measure of the company's ability to pay the interest on its debts. In other words, this measures a company's margin of safety. How many times over the company can make its interest payments. To calculate interest coverage, divide earnings before interest and taxes by the interest expense. Valuation ratios. Wall Street investors and stock analysts scrutinize a company's financial statements and stock performance carefully. This is done in order to arrive at what they believe to be a realistic estimate of that company's value. Since a share of stock denotes ownership of a part of the company, analysts are interested in knowing whether the market price of that share is a good deal related to the underlying value of the piece of the company the share represents. So the valuation ratios help in measuring a company's worth with respect to its stock price. Hence, they are also known as market ratios. The important valuation ratios are earnings per share, price to earnings ratio, price to book ratio. Earnings per share EPS. Earnings per each outstanding share of a company's stock. EPS equal to net income divided by the number of outstanding shares. EPS is one of the most commonly watched indicators of a company's financial performance. If it falls, it will likely take the stock's price down with it. Price to earnings ratio PE. The PE ratio is the current price of a share of stock divided by the previous 12 months earnings per share. It is a common measure of how cheap or expensive a stock is relative to the earnings. Price to book ratio PB. This ratio is the current market price of a share of stock divided by a stock's book value per share. To calculate the book value, subtract the preferred stock total from total equities and then divide the result by the number of shares outstanding. In simplified terms, PB equal to market value per share divided by total assets minus intangible assets and liabilities. To conclude, in order to gain insight into solving your organization's issues, just stop and look at the numbers. I hope this presentation was useful to you in understanding the various financial ratios. Thank you.